If he let me get to the trading desk live, I've got Drew Zimmerman, PI Financial. Drew, it's interesting. I was talking to Dr. Michael Berry, and it sort of reminded me what a change there's been post the election in this way. It used to be that politicians were second stringers when you talked about central bankers. They were the all-stars, it seems, for about 8 years? That seems to have changed.
Exactly, Mike. Ever since the financial crisis, we've been taught to hang on every single word of a statement or a presser or anything like that out of the central bank superstars. And now we're seeing the politicians are really pushing them off center stage, and the words of the central bankers just aren't getting the same amount of movement that they used to. And great proof of that this week is we had Yellen giving testimony to Congress, and she sounded like she wanted to start moving on rates a lot faster than the market had been pricing in. And we had a 2.5% headline inflation number this week in the U.S., the strongest in 4.5 years. And yet the 10-year yield was unchanged this week, Mike. That is unprecedented in our old central bank-driven world.
Yeah, this is a big point you're bringing forward, is that, man, any other time in the last 8 years, you got a Federal Reserve saying, I want to push rates a little faster. You get the inflation number that would support a rate move, as you say, the highest in 4.5 years or 5 years. But here's the thing. I mean, I, too, was sitting there going, the bond market had an initial little bump and then comes right back. And you look at those 10-year bonds, it's like nothing happened.
Well, that's exactly what Michael Berry was saying. The market is giving Trump the chance. They think that his policies could go forward. We're seeing it in commodity prices. We're seeing it in the stock market hitting new highs almost everywhere in the world, but definitely here in North America. And yet the market continues to think the Fed is crying wolf when they're going to go ahead with their rate hikes. So the market's listening to the politicians right now, not listening to our central bankers.
Well, let's come to what it means in the marketplace. You're looking the U.S. dollar kind of firmer, nothing much happening there. What does it mean for you with the Canadian dollar?
I still think the Canadian dollar is expensive in the high 70s. Again, I come back to the hard fundamentals, and for me in the currency market, that's going to be yield spreads. The Canadian-U.S. yield spread's still out over 40 basis points at the 2-year mark, so really implying that we should be seeing a stronger U.S. dollar. But again, it's just going to be volatility. Central banks take action and things get done. Governments say they're going to do something, and it can take months or years for that action to actually happen. So it's just a will they, won't they, as we go along that ride that creates the volatility.
We also talked oil earlier in the show. Excuse me. What are your positions right now in terms of oil? Are you still thinking of it drifts down a bit here? I look at that inventory build, for example.
Exactly. We've seen crude and gasoline inventory builds get to their all-time highs in the U.S., and we've had oil trade in a $3 range for the last 2 months, just very uncharacteristically stable. So we are short. I mean, we're tentatively short. We're not taking on huge positions, but we think that given the huge speculative long positions, the huge inventory positions, that we could see a price crack in oil, and then we would see a wave of selling come after.
Interesting stuff. As I say, it's been a fascinating time. Obviously, as you say, maybe the most major shift being we're not paying as much attention to what's going on, with the central bankers, and it's the political taking front stage. Drew, thank you for spending time with us.
Thanks for having me on, Mike.